People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees, they don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, you can find us, as always, at zinniawealth.com, Zinnia wealth.com. And why would you want to do that? Well, this show is about getting you the help you need, the advice that you need when it comes to your retirement. There's a lot going on out there, and certainly right now with markets, and we're coming up on tax day, and there's so many things to know, and make sure that you do correctly so that you don't fall into one of those traps like so many people that we hear. Charisse, how are you doing today?
Oh, I'm doing fantastic, and lots been going on, especially in the household. Something really cool happened this week with my kiddos. We were in the car doing drop-offs in the morning, and my son all of a sudden started making these bracelets, like Gator colors, FSU colors, through these plastic little bands, and they were really nice. And his sister said, you know, I could actually go sell these to some of the kids at the school. And then she said, you know what, let's do that. I'm like, well, what are you guys going to charge? And she's like, well, for small ones, it's charge $1, and the big ones are charged $3. I'm like, great idea. I was like, you know what? I think we have an Ella and Eli jewelry company we might be starting here. So before we hopped out of the car, I said, Eli, I'll post it on Facebook and I'll send it to friends. And he did a great video. I was so impressed. It only took him 2 takes. And then on Facebook, we got all these orders. And then I got an order for like 50 from somebody else. I know. And here's the key. I said, listen, you know, I give and I donate. I feel like it's the way we should be as humans, help other people. And then we're also making money. And Eli's like, well, what does that mean? I'm like, well, why don't you take 25%? I'm like, this is a high number, but why don't you take 25% of all the revenue, I said proceeds that we collect, and we give it to a foundation. And then we started talking about the Tim Tebow Foundation and the kids that are part of it and everybody they're trying to save. And I said, well, why don't we in the video say, hey, and 25% of our proceeds will go to the Tim Tebow Foundation. And I sent that out to the Tim Tebow group, and they were tickled pink. They ordered their Night to Shine bracelets. And I'm telling you, we got hundreds of dollars here. And the great part about it, which wasn't the intention, is that when I was doing homework with Eli, he was getting frustrated with these math problems. And I said, listen, I was like, the reason why we have to do this math is because this business you started, what if we have 5,000 bracelets ordered? We've already done 1,500. You have to subtract those big numbers from each other and then figure out how many you still have to make. He went, oh. I was like, so that's why math is important. And then we had to mail some stuff in the mail. So he wrote thank you letters and he did the stamps and you got to put the addresses on. I was like, this is why you need to learn to read and write, because he fights me nail and tooth with about this stuff. He just wants to go outside and play. Anyways, twofold. It was a great week at the home office.
Building retirements and building small entrepreneurs. I love it.
Yes. So it's been fun. It's been very fun. So great week.
I love it. Well, what are we learning right now about our economy, and what are we learning about markets? Holy cow. I guess we've used the term in the past, financial amnesia, because we've gone so long where the market just keeps going up, and all of a sudden now we've hit this snag, and the market has kind of gone topsy-turvy on us, and we've lost quite a bit over the last couple of weeks. And so the question is this going to continue? So I have a couple of things here. There are a lot of big companies that are now downgrading their long-term expectations for the stock market. Now, these companies are looking 10 years, and market history tells you that the market gives you about 8 or 9% over a 10-year period of time. Vanguard says they expect 2.8. Goldman Sachs now says they expect 3.1, and JP Morgan Chase says they are thinking a recession is now a chance about 31%. So some of the emotions are starting to go negative, But here's Jason Katz. He's on Fox Business, and he says it's very early to be talking about recessions and things like that.
It's way premature to use the dreaded R word or worse yet, the stagflation terminology. It shouldn't enter into the financial lexicon quite yet. I think we are suffering from this short-term pain, and it's probably getting a little worse before it gets better, because that's how markets move. Pendulums always swing too far, both to the upside and, in this case, the downside.
I was watching a lot of financial news, and people talk about the black swan event, the thing that comes out of nowhere that affects markets. Some people are calling Donald Trump the black swan. So anyway, talk to me about that, Charisse. I know that people will call and say, hey, what's going on? Am I losing money? Is there a place to take advantage of this? I don't want my account to go down because I'm so close to retirement. What's going on in your office?
Yeah, it's interesting. We're getting a mixed bag of thoughts in our office.
Okay.
And I think the first thing is understanding your risk allocation. I don't think people know what the risk allocation is. They just say, okay, we got a 60-40 portfolio, but they don't know what that means in real numbers. And people out there, if you're listening, if you can't sleep at night, you probably are in the wrong stuff and you don't really understand your risk allocation. Because what happened in 2008? Well, big crash came, right, in 2008. The S&P dropped 51%. And it did rebound, but it took, some people 4 to 5 years to rebound after an 18-month decline. So that's a big doozy. And is that going to happen now? I don't know. I'm not going to predict that. We've talked about recessions before in the past, and anytime there's change, there's challenges, and Wall Street doesn't like that. So it moves the pendulum on, the stock market going down. Just a few months ago, we're chasing this rocket ship. We're saying, don't get burned, but it's looking really good right now. But make sure your retirement plan does not rely on the ups and downs of the market. So we are getting some new people who are listening to our show saying, hey, I'm taking like a 7% loss. That means they're in retirement and they don't actually really know their allocation risk strategy, because if that's the case, they're losing 100% of what the market's losing, and that should absolutely not happen. It's like for us, Randy, our big equity exposure portfolio, we maneuvered part of that all equities portfolio to bonds, right, a few weeks ago. So we're making moves because we do active management in some of our portfolios to, try to miss those movements, right? When the markets are going down, and try to hit them when they're going up. And nobody's perfect, and neither are markets. But I have to, go back to understand your risk tolerance. Can you handle the risk? Can you emotionally handle it? And can you afford it? And if you can emotionally handle it, how you make sure you can always afford it is make sure the income that you're living off right now is not in the stock market. Have it in something else. People think that all your money has to make an average of 7% and double over 10 years. That is not true in retirement. You are no longer in accumulation phase. You are in decumulation phase. Accumulation is growth, growth, growth. Decumulation is take some chips off the table, have a couple bucket strategies, have a different shift of 5 different asset allocations, not just a 60-40 portfolio, and make sure the money you are living off the next 5 years is not in the stock market. Those dollars don't have to make 7 and 10%. We just need those to keep up with inflation, make 3, 4, 5, maybe 6%. And there are strategies out there to do it. And I know the conversation out there with Bitcoin, I know the Federal Reserve is going to have some crypto reserved, and it bumped up Bitcoin. Everybody wants Bitcoin, but I'm not telling a retiree, go out and buy Bitcoin. Yeah, I have Bitcoin, but I have more time on my watch for it to go up and down, because there's going to be a lot of noise and a lot of regulation. And we have those Bitcoin portfolios for people, but I'm actually telling people, maybe stay away for a little bit. If you have money you're willing to lose, let's put a couple bucks in there, right? So you just have to follow a strategy and do some math and make sure your income is not being pushed up against a hallway door and it's getting shut on you. And then now it's like you can't even shut the door anymore, because now you're taking so much money out of your portfolio that now you're actually seeing, okay, not only did I lose 7%, but I just took 10 grand for income, and now I can never make that 7% back on that 10,000 on income, right? because you kept it there invested. So we just have to be smart about our decisions.
You mentioned the word allocation, and I'm going to bring this down to Randy level, or AKA third grade. And so allocation is how you spread your money out, okay?
Yes.
Don't put all your eggs in one basket. But if somebody looks at you and says, Charisse, I'm allocated, I'm spread out, I've got 17 mutual funds, 6 bonds, 3 REITs, and 2 ETFs. You know what all of that is? It's all market money. If the market goes up, it goes up. If the market goes down, you go down. You have to look at allocation in and out of the market. And I think that we, as people who've been saving all these years, are just acquainted with things that are in the market. So we have to have that discussion about things that are not affected by the market, and that we have to have something in that bucket as well, don't we?
Well, exactly. You need some protection strategies. You need growth strategies. You need income strategies. And some people are like, well, Charisse, I have a 60-40, so 60% in equities, 40% in bonds. But then I also have some in gold. And I have the stock portfolio where I'm in Nvidia and Amazon and Apple. And the funny thing, it was not actually funny, is that, Nvidia is a great company, but it hit an all-time high of $151 and change, and then it hit a low of 107, right? And you can't put all your eggs in those types of baskets as part of your plan and think you're going to live on those dollars. And some people are now rushing to gold because gold has outperformed Nvidia over the last 12 months, right? So again, having that advisor that can keep those emotions intact so that you just don't hop here and hop there and sell here at the wrong time and buy here at the wrong time. The asset allocation is, okay, what do we need for income? Let's have a couple different asset classes in that income strategy, right? Maybe it's CDs, annuities, money markets. Maybe it's our notes. I absolutely love our 1-year notes. And that's our short-term dollars, right? And they can also be long-term dollars, but money coming out due without losses so we can live off of them. And then we have our medium strategy where, hey, we have this ETF portfolio and it's actively managed. Like we were just saying, we moved some equities to bonds a couple weeks ago just to preserve, hope, because we saw some things happening. And so that is a risky strategy, but a little less risky in our opinions. And then you have your long-term strategy. You don't need those dollars. Those are your Nvidias, your Amazon, your Apples. Even though all those things can be down and then they can be up and they can be down again, you don't need those dollars for 10 or 15 years. So it's great to have those things, but and you keep those things, and you don't just keep buying and selling those things. You keep them for the long term because you really believe in that company. You really believe Tesla is going to be here in 10 years. You really believe those Apple phones are still going to be here, and you're still going to be using those watches, and then they're going to have the glasses, and they're going to put implants in it soon. So you have to believe they're going to be here, right? So you need clarity. In retirement, we just need clarity. We need to understand our withdrawal strategy. We need to keep our fees down. And the first part of all that is just knowing where your income's coming from and making sure it shows up each and every month.
Well, this is where things like a 401k just fall flat. A 401k plan is not a financial plan. It's not a retirement plan. Have you thought about where your money is spread out by those things that Charisse just says, in and out of the market? When do I need the money? Short term, medium term, long term. Have you thought about that? Have you thought about your money, how it's taxed, and having an allocation that way? There's a lot of different ways to spread out your money. And what we have done all these years is just shoved it in the market. And that's all we've done because that's what we were supposed to do in our 40s and our 50s. Well, let's have a different viewpoint of that right now because there is going to come a time when you need to use this money. Let's build a plan for that day. Give us a call at Zinnia Wealth. Look at our website, and let's get a date on a calendar. We call it a complimentary retirement consultation. That's a big term for a meeting where you sit down with Charisse and say, here's what I've done. Here's what I want to do. Do I have the money to do it? And let's start right there. Give us a call, 833-368-3680, 833-368-3680, or zinniawealth.com. You'll see a gold box down in the lower right-hand corner. It says complimentary retirement consultation. When you click on that, you'll be on your way. All right, one of the issues that people grapple with when they go into retirement and pulling the trigger on it is, I don't know what I'm going to do. I'm going to be bored. So there's a Mass Mutual survey out there that asked people, how are you doing in retirement? Are you happy? 67% of people said they're happier in retirement than they were when they were working. Only 8% said they are less happy. So this article says, before you tell yourself you can power through another 12 months on the job, think about whether you really want to. So,
right.
So Sharice, this is something you deal with all the time. The money's there. You're giving them the green light, but they just can't do it.
Do you know what it is? It's the crazy tick inside our brains that we fear that, what am I going to do? Yeah. How many trips can I really go on? Oh gosh, I'm going to get this honey-do list.
Yeah.
And I'm going to tell you, this was the part of the job I really think I love the most. It's, can you retire today? I love testing plans. They're like, no, Sharice, I don't think I can. And I'm like, I dare you. Let me just double dog dare you. Come in. Because I bet if you're planning on retiring in 3 to 5 years, there is an 8 to 10 shot that you can retire today. Wow. And it, honestly, I'll be honest with you. It seems over the last 12 months, it's been like a 10 to 10. Like we've not been able to retire somebody today. Well, the people I'm sitting with anyways. And I will say that retiring today versus tomorrow. And I got to tell you about somebody who recently came in. Mm-hmm. There was a family that came in and they've hit every advisor in the villages in Ocala. And the guy, his wife is super sweet and he's super sweet. They saved, over $5 million. They have like 13 properties across the country.
Wow.
He's 65. She's about to turn 63. And they came in and they drove all the way to my village's office because I live in Ocala to hear about the tax planning workshop. So then they came in and he's like, and he slammed all of his stuff down. He said, I just want a tax plan. There's nobody that can help me because I've already heard. I've got this figured out. And I went, oh, okay. Is that true? I was like, tell me more. Right. Okay. I love that. And so they just told me their story, which was an amazing story. And the one thing I think all the advisors miss is what I nailed down. I just said, well, let me get to know you guys. And I said, what is this $5 million for? Are you even living on it? And they're like, no, we have this and that. We have our real estate income. I said, okay, so you're not even living on this $5 million. So, and if we keep it at the risk level it's at, that $5 million, go to $10 million. And in 10 years from there, it'll go to $20 million. I said, so are your intentions to leave this much money to your kids? Oh, wow, that's a lot of money. That would be great. I said, well, it's all taxable too, so I can see why you're here to consider doing IRAs to a Roth to keep it not taxable to the kiddos. I said, but let me figure out your incomes. But what do you guys do? What do you guys do for fun? And she looked at me like I was crazy. And she went, for fun? We just moved here from Chicago a year ago and we've had no fun. Aww. We're still working. I'm like, what do you mean you're working? She's like, we're always in the yard. We're always doing this. We haven't had a time to plan. And I went, okay. I was like, well, why don't you plan something? And she gives her husband the eyeball. They're so sweet. They're going to be my new favorites, I think. And he's like, oh, I've got this stuff to do. I'm like, is that the real estate? They're like, yeah, we have those properties across the United States. And I'm like, okay. So why do we have all those properties? Well, and she said, well, he wants to keep going and doing things. And in retirement, where he's about to turn 65, he's supposed to relax and not keep doing things. So she's put on the brakes. She's like, no more real estate. We're done with real estate. So they're just still working in retirement. I looked at him and I went, the tick is hard to get rid of. And he went, yes, it is. He's like, the tick is hard, Sharice. I'm like, I know. You got to force it a little bit, I said. And I said, do you have any regret or remorse? He's like, well, I do wish I would have traveled more. I do wish I was a little more present. I spent more time with the kids. But he's like, but we did a good job. And I said, so you're regretful for that? And some things. He's like, yeah, there's some things there. I said, okay. Fast forward 10 years, you're in your go-go years and you still have your wife in the yard fixing fence and doing stuff in the yard. You have an RV, you haven't touched or used in a year, and you still haven't really planned your bucket list the way that you should have in retirement. So let's fast forward 10 years. Will you have the same regret in 10 years when you come to me and say, okay, well, I can't go on a cruise anymore because I'm in a wheelchair, or I'm not good at walking. I don't want to go, I can't do this, or I can't ride in a car because of my back. So think forward 10 years. And he said, Oh, yeah, that could happen. I'm like, yeah, it could happen. It could happen tomorrow, not just in 10 years. And I'm like, I want you to think about what exponentially is going to happen to your body in the next 5 years from age 65 to 70. If you do not get on this bucket list and start taking your wife out and going on trips, because your kids do not need $20 million in the future or more. He's like, I agree, because they're doing well. And he went, he's like, and she looked at me. She's like, you keep preaching. You just keep preaching. I was like, I'm not preaching. I'm going to stop. And she's like, no, you don't. You just keep on going. It was such an awesome appointment. I live for appointments like that because I said, listen, you guys, I'm just the mediator. I was like, I learned this stuff from my own faults. And I'm like, I got a 15-year-old. 8 years ago, I started seeing these gurus that I followed, that I learned my leadership skills from. And they were retiring. They were being interviewed by the new gurus. And you know what they all said? I regret not spending more time with my family, not going on more trips. And after the third one I saw, when my daughter was 7, I said, I am done. That will not happen to me. I will not have regret. And I told him this story, and I was like, you know what? And I spend so much time with those kids, and we do create all these memories. And yeah, I take some time off of work to do it, but I will not have regret. There's no money in the world that can replace that time. And they went, dang. And I said, and you're in the same boat right now. So, and I literally do not screw up the next 10 years because that's what you got. It's going to be the best version of you that you can manage. And they were like, I think I overwhelmed them. I'm like, okay, so now let's do the tax plan. And they laughed. So we went through the tax plan on their first appointment. We wrapped it up. They went, wow, we've never seen anything like this. Nobody showed us this. I didn't know I could roll $200,000 a year for the next 10 years and I only pay this much. And we just talked about everything. So it was a great appointment. So I tell you guys this is because we talked this conversation was about, can you retire now? What are your options? Sometimes our conversations go left field and we're talking about, regret, and we're talking about don't regret not retiring today if you could retire today, because there's so many people that come into our lives here at Zinnia between all the advisors and our staff and myself. And they could retire today, and they come in for their income plan and we'll show it to them. And they're not planning to retire for 2, 3, or 4 years, sometimes 5 years. I'm like, why are you waiting? And I had somebody come in last week that said, because I love this job. I'm 71 years old. I got 5 more years in me. And his wife's like, he loves it. He's not faking this. Trust me. I was like, okay, well, that's more money in the portfolio for later. So there's always a rhyme and reason, but you better love it if you're going to continue to work. But if I tell you can retire, you need to take us up on it. Everybody knows how to do these income plans here, and we will certainly help. Our team is here to please and serve and do our very best and help you understand the plan and the asset allocation and everything that maybe that you don't understand.
Well, I completely understand why women look at guys and go, oh. If you're over 60 years old, guys, here's a piece of wisdom for you. There's something in your garage that you need to throw away. It is called a ladder. There is nothing good that happens on a ladder after age 60, okay? Cleaning gutters, painting, going up on your roof.
Washing your RV.
Exactly. Take it from me. I went out on my backyard pergola to save $300 to pressure wash the arbor. I fell, and it cost me $15,000 in medical bills.
And I didn't have a show host for months. That was a screw up, Randy.
Throw away the ladder and retire, for crying out loud. You got to figure it out. Give us a call. Let's give you the permission to throw away the ladder, okay?
Yes.
833-368-3680. 833-368-3680. Or look at us on our website, zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. Big word for let's meet. Let's sit down and talk through what you want to do in retirement and put the money with it and give you permission and confidence to retire. Again, zinniawealth.com. We're going to take a break, and when we come back, the people at the Wharton School of Business did a survey. They asked people in retirement, is there anything that you could do, if you could do it over again, what would it be? And 3 things kept coming up. We'll tell you what those 3 things are coming up next on Retirement Coffee Talk. Welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth, online, zinniawealth.com. All right, Olivia Mitchell is a professor at the Wharton School of Business, and she's done a book, she's done a lot of research, and they asked people if there is something that you could go back. You're in retirement now. If you could go back to those pre-retirement years and do something different, what would it be? And she said there's 3 things that kept coming up. Number 1, I wish I had saved more money. That's obvious. Everybody says that, no matter how much they've saved. The next one is, I wish I would have waited longer to take Social Security. And then the third one is, they said this.
Older people regretted not having purchased lifetime income. Lifetime income streams would come from something like an annuity, where you purchase from an insurance company a lifetime income payout that will make it much easier for you to manage your expenses. If we explain to people how long they might live, in other words, their risk of living a very long time, they were much more likely to regret not saving and not buying lifelong income payments.
All right. So there's a lot of different ways to develop lifetime income, and annuity is one of those options there that we talk about. But here is what I find so interesting, and that is that people who are in retirement that have annuities really like it. People who are planning for retirement and you say, hey, an annuity might be a helpful thing here, they go, whoa, 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 whoa. No, not to me. I've heard bad things. And it's so interesting to me. It's like somebody who is going to buy a boat and they can't wait to buy a boat, and then they become a boat owner and they're not so happy about being a boat owner. It's like the exact opposite. So talk to me, Sharice. What is the difficulty here? Why are people skeptical about this way to develop income? And why do the people who are in retirement think it's the greatest thing in the world?
You know, it's interesting. There was a time and a place where annuities just really didn't resonate very well with the people who were inheriting their parents' money because how it was set up, and there were old school annuities. A lot of them had tons of fees. And it's interesting, since 2021, there's been a huge change in those thoughts, Randy. There are very few people that come in now saying, I don't want to talk about annuities. I don't want them. They're more actually saying, hey, I've heard these. My neighbors, my friends, and my family have had a reasonable rate of return in these annuities. It seems like they're different. We're reading more about them. Can you tell us about some of these newer ones? So we're seeing a big change in what people are thinking about them, because there's so much news on them, and it's positive news for the first time in so many years. And so it is a cool thing to watch, because I've been doing this business for nearly 20 years, and the conversations have changed. And I will tell you, it seems like every 5 and 10 years you see this big change in something in the financial services industry. It's either a crash, or it's an asset allocation, or it's an investment. You know, went from mutual funds to exchange traded funds because the fees were so high, and exchange traded funds are doing the same thing mutual funds are, but you're cutting, you know, almost half in costs internally. And then CDs became very popular again in 2021, 2022. Now they're going to start getting worse, but maybe not for long. And then now you have the annuities changing, because we're just in a different time period when it comes to bonds and returns and yields and interest rates. And so some of these annuities, there's not a ton out there, but there's a few we will stamp our Zinnia fiduciary approval stamp on because of how they work. And I'm going to be straightforward with you all. I don't believe in all these fake indexes out there. Fidelity's got a fake index, and a designer comes in and then they create an index and then like, hey, let's go put this with this company. And then there's other Goldman Sachs indexes, you know, and I stick to the tried and true index, Randy. It's one that just always wins if the market's going up. It is the S&P 500. Because when I weigh all these fake indexes with these big companies, the big names, and these people are selling these things to you, it sounds good. You get 300% participation, but are they good? Do they smell good? Do they sound good? And do they taste good at the end? Meaning that's your payout. And over and over and over again, I try to preach this. S&P 500 typically wins 99% of the time. And so if you have really great allocations and strategies inside that annuity, then we're all about it. But it has to have that S&P 500 index, not the S&P Mark 5, not the S&P Volatility Control. I'm talking about the straight up S&P, the one you see on TV, not one that a manager is manipulating and then you're going to make less on average. So the thing is just understanding the product. We have a great book. Anybody who wants to read this book, it really goes through the nuts and bolts, and it's so easy to understand. And if anybody ever decides to get that annuity in our office, they have to read it. It is actually a prerequisite because you're going to have all those questions answered inside of it that maybe sometimes the advisor misses because who knows why. So nevertheless, don't be afraid of them. Don't disregard them. Just do the homework and make sure the advisor who's offering them to you, they're in a place where they can also offer you investments in the market or other alternatives. It's just not 100% annuities.
Well, if we were to ask you, if you could go back 10 years and have bought NVIDIA or Google or Amazon or Meta, ask anybody that, they'll go, heck yeah, 10 years ago, I'd have had that. I'd jump on that in a shot. But now you have retirees that are looking back 10 years and they say, you know what I wish I would have done? I wish I would have bought some guaranteed income.
Yes.
So let's learn from that. Let's say, okay, this is the piece of the puzzle that they didn't get. Let's not let you miss that piece of the puzzle.
And let me also add something here. So annuities, when you think of the definition as annuitization, it just means an income stream. There are a couple different types, Randy. And so there's an annuity that you pay a fee for on average of 1%, and you get a guaranteed income for the rest of your life, and you can set it up that your surviving spouse gets an income for the rest of your life, right? So that's income that's covering your fixed bills, things that you need today. Sometimes we need those in our office, and actually a lot of times we really don't, to be honest with you. We like the growth annuities. It's ones without the fees that they're charging every year. It's a one that is based on whatever the S&P 500 does. You're going to get some of that, right? You're going to be able to participate in it. And then when the S&P loses, you don't take a loss and your account doesn't go down because there's fees. So we like those. We're using those as bond replacements because bonds are just all over the place. You make your money now you're losing your money in the bonds and all the yield that you had already earned for the last so many months. And we just want consistency. And we can take 10% a year from those. And, if you got $100,000 in there and you take 5%, it's 5,000. If you need your 10%, that's 10,000. But you don't put all your eggs in one basket. We have some stuff in notes, we have treasuries, we have equities, and we want to be able to pick and pull from different asset classes when the time is right. And the market crashes and you had this account that we were pulling from, then hey, mitts off. We don't touch that one. We pull back the reins and we pull more out of these annuities. And so it's a strategy. It's a withdrawal strategy that actually isn't forever. It's not a set it and forget it. We got to bob and weave over time. So it's just understanding it and the value of it and deciding if you want 10% of your portfolio in it or 30. I've had people come in and said, Sharice, I want 100%. I'm like, not in this office.
Yeah.
We want to be diversified. We want more liquidity. We want more opportunities.
Well, the economy changes, stocks come and go, different financial vehicles come and go, and there is a reason that over the last 3, 4, 5 years that every single month there are more annuities sold, and it's because baby boomers are saying this: I want to replace either my whole paycheck or a portion of my paycheck, and this is how I'm going to do some of it. And they're all getting into retirement, and they're looking for that income. This is one way and one discussion that we can have. See if it's right for you. And we'll do, as Sharice always says, let's do the math. Is it right for you? Let's find out. 833-368-3680. Again, 833-368-3680. What does that get you? It gets a complimentary retirement consultation. That's exactly what it is. It's a free sit down where we talk about what you want to do in retirement, what you've done for retirement, and match them up and figure out, are there any gaps there? How can we help? And then all the questions that you have. When should I take Social Security? What am I going to do about Medicare? What are we going to do about long-term care? All those questions. Let's get them answered. 833-368-3680 or zinniawealth.com. Well, Sharice is a golfer. I'm a golfer, so I found a story about golf, and it happens to be from Jerry Seinfeld, so double thumbs up on this one. This is Jerry talking about the meaning of golf.
A game so nonsensically difficult, so pointless, so irrationally time-consuming, the word golf itself could only stand for get out, leave family. all golfers say the same thing to you. It's a very challenging game. I'm sure it is. It's challenging trying to throw a tic-tac 100 yards into a shoebox. That's not a reason to devote thousands of hours to a game that even at its highest skill level is basically whack. Where is it? Oh, damn it.
That's hilarious.
He has got it right on the button.
Oh, goodness gracious. We've been sold something. I mean, what human being takes a skinny little stick to hit this little ball, and I can hardly even see anymore the line when you're putting. It's like, did I get that right?
That's
but
fun.
it's that tick that we have.
I know. I'm at it 3 times a week, out there practicing and trying to make my way to the weekend and do well. But
Well, can I tell you this much? Just before we get into
Go
financial
ahead.
planning, because it's about me right now, everybody.
Yeah.
I'm just kidding. No, because I have to talk about this. I've been really coaching up my son Eli on golfing, and this week was a week that we went out to the range 4 times, and we were out there for an hour, and he's hitting solid as a 10-year-old.
Nice.
And then what we do, we'll play like 3 or 4 holes so we don't hurt ourselves or wear ourselves down.
Yeah.
And we have used his ball more than mine. I'm thinking, oh my God, I'm so proud of you, son. I said, anyways, I'm going to be
That's
on the
great.
sidelines when you're a pro. So anyways, but he's doing great. So I know we're making fun of golf, but I really do love golf.
Well,
and it's fun.
It is. And the one thing that you go onto the course and you always say to yourself before you play is, I want to avoid the big blow-up hole. That snowman, the number 8 on your scorecard.
Because you'll end up on 19, hole 19. We know where that leads you guys. That's not good.
So, because sometimes one big blow-up hole can ruin the entire round.
Totally.
So what I want to get at is there are people, including myself, who've made a lot of mistakes in their life financially. You dipped into your 401k to get out of credit card trouble. You leased a car instead of buying a car. You made a bad investment. There's something in your life that you've made a mistake. And this is holding you back from sitting down with somebody like Charisse. You got divorced. You had to cut everything in half. I get it. But Charisse, that should not be a reason that you say, I'm just going to work forever. I'm never going to be able to retire. Talk to me about that conversation and how it unfolds when we talk about our complimentary retirement consultation. This is some of the stuff that might come up. And how do you work your way through that?
We can't change the past, but we can certainly help for the future. And I have people listening across the country to this show. And a new gentleman that came to us last year from North Carolina, he's in the middle of a divorce. And there's a lot of assets there. And I think he was more embarrassed to come talk to us. Divorce is a tough one, right? When you've been married for maybe 20 years. But I basically said, listen, you've been married, you guys have kids, this is the equal share of world here in Florida, because this is where they are married, and he still lives here too. And I said, but we can work with what portion you're still keeping, right? And then we can manage that moving forward to make sure that you still have the income that you need and still have the growth, and you can still leave your own personal legacy. And it just gave them peace of mind, because life happens. I'm telling you, it happens, and you never know what's going to happen tomorrow. So I always say, carpe diem, seize the day, because there's no guarantee for tomorrow. And so you need to live life like that a little bit more, people. Enjoy it. Take what you have. Let's see if we can enjoy those dollars even more. Can I get you $10 or $20 or $40 or $50,000 more a year in income than you ever intended, because you didn't understand the plan and you feared running out of money? But when I came in and I showed you, no, you can retire today, and we don't have to have that fear of running out of money based on this plan. Let's look at it. And there's still possibly money left over as a legacy, right? I mean, every household's different. Not everybody's going to be the same here, but just being comfortable and being okay and not being bashful or discouraged because maybe you've been bumped around a couple of times. You've been hit with a bat. You fell off the horse. Get back up. Let's go. Let's make the next time of your life count. And I believe that. And I want people to know that, like, we understand you. We understand life hits us, and we don't know why, and we're embarrassed, or maybe you feel like you didn't save enough. You're the perfect person to come in and see us.
Well, talking from a person right here, folks, who's been fired 4 times in his life, I had to reinvent myself in many instances, go from one career to the next, and then we just started all over again. And if it's a career thing, if it's a personal thing, if it's a financial thing, whatever it is possible to have a great retirement. So let's sit down, as we say, let's do the math. Let's take you from where you are right now and move forward. That's why it's so important, I think, to come in early. If you're 3 years from retirement, 5 years from retirement, and you think, I'll never be able to retire. Well, let's do the math. Let's sit down. Let's get some of that debt gone. Let's get you on a place where you can save money, put more in your 401k, whatever it is, to help you with retirement.
Yeah. And, you know, I want to say something else, Randy. So we do income planning and we do wealth management here. So if you're just starting to save right now, unfortunately, we won't be able to help you, but we can give you direction on the company that can. To create these plans and all these strategies, we do have to have assets, liquid assets, and IRAs or Roths or other accounts that you have saved up to create these plans. So we do have to have a little bit of a nest egg saved to do that as well.
That's a good point, and we would love to be able to help you. Whatever your situation is, if you feel as though I made a huge mistake in my life, don't let that hold you back from sitting down with Charisse and talking about and doing the math on your retirement. ZinniaWealth.com is our website, and our number is 833-368-3680. All right, so Dave Ramsey, he's got a show every single day, and he's out there helping people get out of debt, and that's been a wonderful thing. He also talks about some financial advice. Social Security came up not long ago, and Dave said this: you should take your Social Security at 62, even if you're working, if you are disciplined enough to invest it wisely. Now, Charisse, do you think that people are disciplined enough to take that Social Security check and invest it and make it work for them for later in life? I know I couldn't do it. What do you think?
I have had people do that and say, Charisse, I don't need this money, but I don't know how long I'm going to live. And if it's a break even, if it's 81, you know, my parents didn't live to 80, so I'm probably not going to live to 80. And so I'm just going to go ahead and take it. And I will tell you over and over and over again, they're like, we're going to reinvest it. We're going to do this. I never see that money ever.
I knew it.
It's good. I understand the heart's there, but then when you get it, we're like, ooh, what can I go buy, right? Or what can I got grandkids. Oh, Christmas came up, so I get it. So not too many people are that disciplined. I just came across another one like, yeah, we're going to do this. And what I want to do is put it in here. I'm like, okay, I'll believe it when I see it, but let's just see where we go with it. But for them, the longevity, and they had some health issues, for them, it made sense to go ahead and collect Social Security at 62, right? So it depends on your health. It depends on your wealth, on if you should collect Social Security at 62 or 67 or wait to age 70. And it depends on if you're working or not, right? It depends if you just had somebody pass away. There's so many reasons to take it early or take it later. But I will tell you, my hard, fast rule here at the office and our staff and our team here says the same thing. If there's 2 people in a household, and let's say the Mr. is 64 and the Mrs. is 62. And if Mr. waits to 67 to collect Social Security, he gets $3,000 versus collecting it right now and only getting 25. It is better for the higher income earner to, if they are the higher income earner, to wait to age 67. And if the spouse who was staying at home with the kiddos and they didn't have much of a Social Security, if they can get $1,000 now collecting versus $1,300 or $1,400, 5 years from now. Yeah, I'm going to say allow the person, and don't mark my words, I do not work for Social Security. I am telling you some math and how we figure some things out. Come see us before you make this decision. But it does make sense in math, when I'm doing the math, for the person who's going to collect less to go ahead and collect it early. Because what if you guys are healthy? But what if mom and dad lived to 80 or 90? But what if you passed away before 80? Then it would have been a better strategy to collect Social Security at 62. But the value of waiting for the higher income earner to collect their Social Security later is this. Let's say Mr.'s 64 and we said, let's wait till 67. When one of you pass away, here's the easiest way to understand it. One Social Security goes away, and it's always the smaller of the two. So if the Mrs. has 1,000 and Mr. has 3,000, the 1,000 goes away. As a matter of fact, how to look at it And then you get to keep the $3,000. So you might as well let that $3,000 grow a little bit longer in case one of you do live past a certain age. So there's a little bit of a strategy. Once in a blue moon, we have somebody that's going to wait to 70. So it really depends on the household, how much you've saved. So we're going to take inventory. We're going to say, okay, here, what are all your fixed incomes? What are all your liabilities? What's our disposable income? Do we even have disposable income? And we sprinkle in the travel plan, and we figure it out based on that. So you bring in your box of stuff, and we're going to dump it out on the table, and we're going to start dissecting what you have and then put a plan together so we can really figure out the nuts and bolts of when you should take Social Security or not take Social Security. But I will forewarn you, never listen to these big gurus, because half the time they don't have a flipping clue. This is wrong intel, wrong information, but everybody bleeds and bows down to Dave Ramsey, but he screws up his conversation over and over and over again. And there's some things he says that are spot on, that are so right. I love the man. I was an ELP with the Dave Ramsey group, so they liked me too, but their strategy is different than my strategy. We're working with people 50 and over. Dave Ramsey's team's talking for a conglomerate of all ages, from ages 10 to ages 80, but it's the same story. So he can't do that. So if you want it more carved in for your plan, that's when you come and seek the advisor's advice that does this every day.
That's a great point. And I think I get it. There are some people that need to take Social Security at 62. That's fine. And we can identify that. If you're one of those people, then that will probably be the recommendation. And I realize that some people will say, hey, you can't pass on your Social Security, but you can pass on your 401k. So take your Social Security early. I get that too. But the part that I really raise my eyebrows at is take Social Security while you're working. Because there's a tax situation there that you may lose, half of your Social Security check, because you're just pounding on income and you're losing half the check. So why is that such a good thing? That's where I have a problem.
Yeah, from ages of 62 to full retirement age, which could be 66 and 8 months, or actually age 67, if you make too much money, and it doesn't have to be that much money to make too much money, they start taking, and you collect Social Security, they'll take $1 of every $2 out of your Social Security check, so you won't even see that money. There is something called Senior Citizen Freedom to Work Act. Now I'm geeking out, Randy, sorry. But it does say if they take money out of your Social Security check, when you do hit full retirement age, they will pay that back to you, but not in a lump sum. It'll be over all these years, as long as you live long enough, of course, but that doesn't go to anybody if you die. So just know there's some rules. This is why you come see us. We do retirement planning. We geek out on all this stuff you don't even want to know about, but we're going to pinpoint it, and we're going to shove it down your throat and say, this is why.
Okay. I love it. Well, let's sit down and have that conversation. If that's one of the things that you're wondering about or worried about, let's do the math on it and figure out what the options are there for you. Our number is this, 833-368-3680. Again, 833-368-3680, or our website, which is zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. That's the meeting. That's where we sit down and really kind of go through some nuts and bolts of what you want to do, what you've done, and are there any gaps there to fill so that we can help you to do what you want to do in your retirement years. Again, zinniawealth.com. Sharice, that is all the time we have on this one. I'll give you the last word.
Again, we appreciate your time. Have a lovely rest of your day. Live by design and not by default, and we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, Investment LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past-specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and/or categories usually do not deduct transaction and/or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.